Canada is starting to feel like it's losing its luster, its shine, its appeal, really, especially when it comes to the standard of living and housing. In fact, the US Census Bureau just stated or put out a number that, in fact, the amount of people moving from Canada into the States in 2022 was over 125,000 people, which constitutes a 70% increase from where it was just a decade earlier. We also see that foreign investment is fleeing this country. These are all not very great signs of a prosperous future. So in this episode, we're going to get into more of what's happening within the country and how it's all going to affect the real estate here. Let's start off with population, because Canada's population has just recently crossed the 41 million mark. And it's growing currently at the rate of about 4,000 people per day. That is according to the StatCan real-time population tracker, which you can go view on their website. So 4,000 a day. When we do some simple math, we realize that that's almost 1.5 million per year. And based on the Q1 count provided and compare that to the real-time tracker, the population has grown 480,000 in just the last 2 months. I mean, what? Let's wait for that all to hash out. But, if we look back at the last 2 years, we've been growing at the rate of about 1.2 million people for the last 2 years. And that, of course, was essentially flagged as being too rapid of growth for the country to handle when it comes to housing and infrastructure. But now we're seeing it go even higher. I mean, sure, that tracker, it's a snapshot in time. So let's wait until the final tally is actually in for Q2 here. And of course, Q1. But even if half of that number is correct, well, we're already well above the 2024 population growth target set by the federal government. Based on this data from StatCan, the population rate looks to be increasing and would be considered out of control, essentially, based on these federal targets. Now, to be fair, Q4 of last year compared to Q1 of this year shows growth at 241,000. Okay, so if we annualize that, we're looking at more around 965,000 people, which would be a slowdown from the 1.2 million the couple of years before. Obviously, these new policies to kind of slow the rate of immigration, they take time to filter through. So we're going to keep an eye on this, of course, as it all starts to unfold. But as of right now, it's not like it's going to be a dramatic slowdown in the population volume of numbers that we've seen in the last couple of years.
That's unfortunate, because I don't think that's going to lead to an increase in the quality of life. I mean, the more stress that our goods and services have, the less likely you are going to be able to A, afford them, and B, have them in your life too. So that's a concerning comment, especially considering I think the government has promised to slow this down, but it needs to be at like half that number, in my opinion, in order for us to start to experience some kind of recovery here. I don't think that's in the future either, because as we look at building permits going into the future, it's a scary sort of proposition as well. Building permits issued in March fell 4% month over month, including a 7% decline in the single family segment, further demolishing any of the chances that the Fed's 3.8 million homes are going to be built over the next 7 years. Fortunately, there is currently a strong pipeline of homes that are under construction, though the dramatic slowdown in building permits points to a major supply shortage in the coming years, especially in the most popular provinces, or the most populous provinces, I should say, in Ontario and BC. You've likely heard of the recent spike in inventory. Well, part of that is thanks to a spike in completions of newly built property. New home completions have been on the constant rise since mid-2023 and are at least at a 7-year high. But on the back of this comes the reality that units under construction are falling. This number peaked at about 220,000 units last year and is now down to 210. It's a modest decline, but a dramatic reduction in building site sales. If you reference an article that was put out by Collier's here, all point to a significant shortage of new homes being built in the next few years. To that point, if we go back to, I think it was 2022, there were about 600 acres, I believe, that were sold through Collier's report. Fast forward to where we are now, is just over 200. And if you go back to 2018, that was 1,800. And these are all over industrial properties, things that we need in order to build tower forms and bigger sites. So you can see a dramatic reduction in purchasing because none of these projects are penciling out at today's cost. The land value is too high. The cost of construction is too high in order for a home to get built on this, for it to make any reasonable sense for somebody trying to buy it.
Yeah, it seems like the writing is essentially on the wall for a future supply crisis, on top of the one we're already experiencing. Because again, you cannot have this large of a pullback from developers nationally without that equating to a minimal amount of supply in the 4, 5, 6 years ahead. Now let's do a slight shift here and talk about the supply today, and of course the people that have mortgages on that supply, their homes. Because OSFI shared their annual risk outlook just last week and pointed to some interesting facts that I want to share with you. Of all the mortgages outstanding, about 76% of those will be up for renewal between now and the end of 2026. That's higher than normal, right? If you add today to the end of 2026, a typical cycle would be about 60% of the mortgages that exist were outstanding and renewing within that time. This 76% of all outstanding mortgages does include the ones that have already seen payment increases and short-term mortgages that already have higher payments, right? So it's all outstanding. Fixed payment variable rate mortgages, which have not seen an increase, but have dramatically extended their amortizations, right? We've shared those stories of 50, 60, even 100-year amortizations. Those make up about 15% of the total mortgages within our country here. That segment will especially feel the payment shock at renewal, should rates obviously not come down significantly, which, by 2026, who knows, doesn't look all too likely. Those payment shocks, if you will, in today's landscape would be 50 to 60% higher should they be renewed today. That takes a $3,000 mortgage and turns it into $4,500 per month plus. Now, this conversation has been going on for over a year, and while the arrears rate remains near all-time low, we are far from out of the woods yet. And there remains, of course, the possibility for a future spike in inventory and insolvent owners as the next 2 to 3 years unfold. People are kind of at the bare end, it feels like, of maybe their financial abilities to stay within their home and stay solvent, as we share, of course, with credit card balances increasing and all these business insolvencies. So keeping a close eye on it, and we will continue to share the information, again, as it unfolds.
Well, remember too, Dan, I think it was a couple of weeks ago we shared an article out of the US that all of the savings that happened during the pandemic, the $2.1 trillion that were saved by people like yourself and me, that money has been completely spent. There is none of that left in the economy anymore. So there's no more cushion. So it's going to be very interesting to see how things continue to unfold as we go deeper into this. And, when we start looking at credit card balances, it's not getting any better. So credit card balances are continuing their upward surge. They're now sitting at $106 billion in Canada. That was up from $75 billion in 2021, an increase 40% in just 3 years. This is obviously a sign of a weakening economy. Anytime you have to borrow in advance, especially things like buy now, pay later. That was a very, very popular thing. But now as we're seeing interest rates have come up dramatically, being able to pay later is becoming much more difficult. And there's a whole fundamental issue there of paying for things before you even have the money to buy them. It's the sign of a weakening economy. It's the sign that people can't afford the things they need in their life now. So domestic business lending by chartered banks fell for the third straight month in March. On an annual basis, loan growth is at its lowest rate outside of a recession, the lowest in 25 years. While mortgage arrears at major banks is still low, we're seeing something very different at smaller lenders. These loans are typically to non-prime borrowers. So the prime lending market generally refers to a client with a TransUnion credit score between 720 or more, with 900 being a perfect score. Scores below 720 are considered non-prime, and generally speaking, lenders charge higher interest rates to clients with lower credit scores, naturally, as they have a higher risk. So when you keep in mind that most of these particular mortgages are between 1 and 2 year terms, it's not that surprising that this particular segment is beginning to spike in arrears. It's up to 0.45%, but that's actually quite dramatic considering it was at 0.12 back in 2021. Is this a crystal ball for what we can see from prime borrowers? I guess time will tell. But lastly, when we touch on housing affordability here too, it's improved slightly month over month, although I'm sure you're not feeling that because you're probably paying it in a different part of the economy. But the monthly mortgage payment required to buy a typical home is now $3,225, down from $330 in the peak pain payments of September 2023. It's still over double from where it was in 2021.
So all these factors are obviously leading people to want to leave the country. It's no fun when you can't afford the lifestyle that you thought you could have, or maybe that you did once have. And we're also seeing the same thing happen right now with foreign investors. The country as a whole, as an investment from the outside, is not as attractive as it once was. Just this morning, the Wall Street Journal noted that foreign investors withdrew about $6.2 billion out of Canada in Q1 of this year alone. This marks the first divergence in 14 years. Because in contrast, Canada's investments abroad are more than 5 times that, or about 5 times that, at $30 billion. The data shows that Canada's direct investment abroad has outweighed foreign direct investment in for about 5 straight years now. This, of course, points to decreasing interest that foreign entities have in investing in our country, which demonstrates how poorly the country is being run, in our opinion, especially when you consider how incredibly resource rich we are and that our resources are simply being underutilized to a degree. Foreign direct investment, let's be honest, it creates jobs, it creates opportunities for the Canadians that live here. It spurs economic growth. And with that number of investment dwindling year on year, it further sets up the country for decreasing GDP and employment. Not good for today and definitely not good long term. So that needs to shift in order for the country to thrive. It's that simple. We have to be able to be attractive to foreign investment. And right now, it is definitely trending the wrong way.
Yeah. I think the last piece of that too, Dan, is that your quality of life is what ends up suffering. If a business that exists in another country that has a productive capacity in the economy that improves something, but they're not coming up here because capital gains tax has been increased, or it's just not worth it for them for a multitude of reasons because there's better performing economies, that means that's a lower quality of life for a business that would exist here, but we can't have it for a ton of different reasons. But ultimately, it sucks because the money that should be coming into the economy, the money that we need for investment to produce better lives, is going the opposite direction right now. Let's touch on inventory too, because Vancouver wasn't the only area that saw a spike in inventory in April. BC overall saw a 43% year over year increase, and Ontario a whopping 58%. Canada's total active inventory rose by 6.5% in April, the largest monthly increase since June of 2022. The nation's total available listings sits at 160,000, up from the lows of 90,000 back in 2022, but well below the recent peak of 250,000 back in 2015. And Alberta apparently is really the only outlier hitting a 20-year low in inventory, as that's, I would imagine, due almost entirely in part to its affordability, to the fact that people can buy a house over there for half of what it costs here in BC. So there's no surprise that that province is seeing an all-time high in real estate prices. And May's data will be out next week, and it'll be very interesting to see if the nation's inventory spike was a one-off or if this is a trend moving in that direction.
So if continued increase in inventory happens over months and months and months, typically that tends to put downward pressure on prices. But we continually see downward pressure on prices to be short-lived, and maybe this next segment is a little bit of insights into why. You probably saw this circling around Trudeau, our prime minister, this last week was out in an interview and basically came out and said that, look, real estate needs to be more affordable, but lowering home prices would put retirement plans at risk. Okay, this is a very telling statement from our leader here. We've known it essentially all along, but to hear it from the leader of the country, well, I think it's opened up a few eyes out there. On this channel, we've been saying it for years that the government protects housing in Canada. So let's look back. What do I mean by that? Well, if we all remember the COVID crisis where homeowners could opt out of paying their mortgage for 6 months, it was the first thing the government did when the shutdowns happened. They protected housing. Then we saw this ensuing rate hiking cycle where stretched homeowners could just decide to extend their amortizations, protecting homes and prices, keeping people in their homes. And then, of course, there was the recent housing charter, which enforced banks to essentially help financially stressed homeowners have options into staying into their home. Then look to your, prime minister, who's now said it publicly. The government they're in more of a position to prop up housing prices than help people get into the market. And why is that? Well, there's a few obvious reasons, I think, here. One of them being, of course, that most Canadians are homeowners. So politicians, of course, are going to pander to their largest voter base. On top of that, the vast majority of politicians' funding base are going to be homeowners. So you don't want to take out of their pockets because they'll do the same back to you. And lastly, it's likely the easiest path for the country to basically help people retire on their own accord, right? If you prop up their housing price by 400% during their lifetime, they might be able to retire on that as opposed to leaning on the government for aid. This likely won't come as a surprise to many people, but it's almost refreshing, if you will, to see the obvious, albeit inconvenient truth out there for the public to see. So, will that change with Trudeau voted out at the next election? It won't. I honestly believe that it would not change. You got to think of it like this. There is simply no politician out there who can campaign on lowering home prices. They would guarantee their loss. They just can't do it. Yes, you can campaign on making housing affordable, but that's by doing things like, taxing the demand and adding additional taxes and creating little first-time homebuyer incentives here and there. But never did they say in the same sentence about making housing more affordable, did they say making home prices go down. I had an idea just this week that I wanted to share with everybody, and it's not fully formulated, but hopefully it opens up a discussion, and Ryan, would love to hear your feedback as well. Okay, so how do you actually help people get into the market, right? Largely first-time home buyers or people that are new to the country. Taxing the demand doesn't work. First-time home buyer grants don't work. Well, how about this? If the government were to actually build homes where they didn't have to pay their own taxes and it wasn't built by a developer who wanted to profit from the situation, from the build, that would literally make a home 50% less expensive. Because we're looking at about 33% of new homes are taxes, and the other 17 to 20% is developer profit. You remove those two from the equation, and you have a $1.2 million home going to market for $600,000. Okay. Now, obviously, they can't build enough to supply the whole nation, but let's start, right? Let's pretend they build 100 or 1,000 homes. And there would be a huge amount of people wanting to buy them. So they're bought essentially on a lottery system, right? 10,000 names go in, 1,000 come out who win. And here's the catch. Here's where I think it could potentially work. So let's say you buy that home for $600,000 and you live in it for 5 years. The rest of the market has gone up 30%. Okay. But the house can't be sold for a inflated amount. It can only be sold for an increase on par with the rate of inflation. And it can only ever have one buyer who got the chance to buy that home through the lottery system. It can never be bought over or under that price, right? It just flows with inflation. People, owners who have these properties would still benefit, of course, though, because they would benefit from the mortgage paydown and the stability of living in a home where you can't be rent evicted or whatnot, or the property can't be sold from underneath you. So again, it's a top level thought, but wanted to kind of share that with people to see if there's some feedback here. I'm missing something, I'm sure, but it seemed like a good idea at the time.
Yeah.
Some feedback on that one, Ryan?
Well, I think what you're effectively talking about, to to me, is it we've got a we've got an inflation problem. We've got a money problem, because whether it's houses going up in price or money going down in value, one of the two, we've got a problem. And when 50% of that problem are by the people who can either produce the good or service, or who tax the good or service, the whole system itself is kind of corrupted, right? We've got taxes in many ways is effectively, in my opinion, it's a lot of theft, sanctioned theft within the marketplace. And I think builders, you're not going to be able to get away from builders wanting to make a profit or a margin, but effectively what we're talking about is creating, I think, more productive economies and better sort of money. I mean, put it this way, Dan, if money didn't lose value the way it currently loses value, the way inflation has, lost its value, you end up having all this kind of anxiety around money. Money should be the means to the end. It should be you using the money to buy the house. But when the money goes down in value and the house goes up in value, all you can consume yourself with is getting more money so that you can try and catch up and have a house. And that's inherently broken, right? If the very system that we use to store money or store value into the future is busted, then how do we, we're just tearing off one Band-Aid and putting it over here, as opposed to actually looking at what the problem is. The problem is, in my opinion, rooted in a much deeper issue than supply. It's we have a broken system here that gets abused by people who are closest to the money creation. I mean, you look at the actual value of money that's gone up over the actual value of property that's gone up in the last 3 or 4 years. It's 30+%. That's equivalent to the amount of new money that's in the system. It's not, to me, that's how I see it. I see it as a fractured system, and every politician is just trying to put a Band-Aid on a fractured system when we need more revolution in that respect. We need a better system, and it's all broken. So I don't know. It's probably not the right answer.
No, fair. Hey, no, it's on point. And let's, turn the conversation then to the people who do kind of make those decisions, i.e. Tiff Macklem and the Bank of Canada, because we are recording this on May the 30th and it comes out on June the 1st. And on June the 5th, prior to our next episode, the Bank of Canada is releasing their next rate announcement. Are they going to cut? Are they going to hike? No change? Well, right now, markets are pricing in only 0.5% cuts for all of 2024, with the first one coming in July, not next week. The longer term outlook points to about a 3.5% overnight rate by 2026 and maybe down to 3% by 2028. I mean, predicting 4 years in the future is next to impossible, but that's what they're doing right now. Obviously, do not expect, it is very unlikely that any of us will ever see a 0.25% overnight rate again. It's just the reality. Unless, of course, the world falls apart again, right? That black swan event. 0.25% has only been seen twice in all of humankind. It was back during the global financial crisis in 2008 and during COVID. That's the only time that level of rate has been hit. So again, who knows the future, but it takes that level of extreme, a global crisis, for money to be that cheap. So an overnight 3% rate would actually be very normal and to be more expected. And ultimately, if that was just left alone, that might actually create a bit of a stable housing and investment landscape. What's your take on that?
Yes, I tend to agree. I don't think we're going to see rates down where they were before. I think we should see a 3% rate again, though I think a lot of it'll depend on whether or not we experience a black swan event, like you mentioned. That can clearly throw a wrench in kind of everything. And I think as we continue to look more and more long term, we need to come back to some kind of parity between the amount of money that's being earned and the opportunity to buy homes. And having a restrictive level of credit doesn't really do anyone any favors. It needs to flow a little bit more. But, and I'll say this, as much as trust me, I'm on a variable rate mortgage. As much, there's nobody who wants rates to cut faster than someone like myself. But the more I look into this, the more I'm just not sure if cutting rates in June is even if it is only 0.25%. I was looking back at the last bunch of rate cuts over the historic sort of last 25, 30 years. And they're almost always followed by a rate hike, which is kind of interesting because oftentimes they want to do it before it's ready. So, as much as I would love to see it, I'm very cautious about it being the right approach, even now.
Okay. So lastly, to wrap it up here, as we are on May 30th and the month of May is almost done. And so we've got, of course, a lot of the sales data as to what's happened. And we'd love to give you sort of that first look as to what you can expect to hear from the real estate board in about a week from now. First off, and the most fascinating is that average and median prices went up this month, and they are both within 0.5% from all-time highs.
I don't understand that.
Yeah, no, it's contrarian to a lot of what people would believe here. That, of course, is going to push up the HPI, which will likely end up at the end of this month being at a 2-year high. So we've got HPI at 2-year high. We've got average and median just up, 0.5% under all time. And what's crazy about this 2-year high is that it was also 2 years ago that the rate hiking cycle began. We've had 5% overnight rates for 10 months. And here we are, Vancouver prices are pushing up with average and median basically at all-time highs. It's almost illogical. We'll dive into it more next week as well to kind of give you our reasonings as to why. Sales overall, though, definitely low. When you look long-term, it's going to end up around, 2,700, somewhere like that. Slow, but you look back 2 years and it's the 5th highest month of sales over the past 24. I don't know, I'm stretching there, but you get the idea. And inventory is going to be the story. Yep. April was not an outlier. We absolutely are seeing a huge spike in new listings this month, and it will push up inventory overall. New listings this month so far, about 6,400, which is a big number, of course. And we're currently at over 14,000 active, but we'll see where that all washes out once all the people delist and whatnot at the end of the month. Yes, Ryan, I can tell you're thinking about something.
It's just rattling my brain. Like, how do we have restricted levels of credit, surging inventory? We've got very limited prospects on the future in terms, maybe it's coming from there, but that's a futures market analysis. I'm just trying to find out, why we are still headed towards higher and higher prices when, sound fundamental economic reasoning would tell us that they should be going down far more than they have. I just don't. Obviously, it's a very complex picture when it comes to Vancouver real estate specifically. It must be a result of just not having enough active inventory, even at today's levels. I'm trying to figure out, or maybe money has to become even more restrictive. It's like you said, though, politicians are not campaigning on lowering prices. They're trying to campaign and figure out a way to get you into a home. So maybe there's something that we're not seeing, but it baffles my mind.
Yeah, you're not alone there. And I think the answer is simple. It's Trudeau. Lowering home prices would put retirement plans at risk. So he's pushing them up. Jokes aside, it is fascinating. And we're going to dive into that more next week and really kind of talk about how prices are still moving upward here when places like Toronto are heading the other way. Thanks as always for tuning in. Really appreciate you and your support. Have a wonderful day, and we'll see you here next week.